R. Let us now move on to the LLTTU, which are your constraints. So RRTTLLU. Time horizon, tax concerns, liquidity, legal and unique circumstances. We've already talked about these multiple times before, right? Time horizon is what is the maturity of the investments. And I just always like to give this example about Silicon Valley Bank and First Republic Bank and Signature Bank, that they were using the depositors' funds and buying 10-year government bonds. So clearly there was something wrong in that portfolio construction, right? Tax concerns, of course, varies from investor to investor, depends on where they live, what passport they have. So different citizens of different countries will have different tax laws applying to them, and they could be a resident. So you and I both could be buying a Tesla share, right? But the tax laws might be different for me and might be different for you, depending on what passport you have and where you are a resident of. So citizenship and residency will determine the tax status. And liquidity, again, this is something which is linked to your time horizon. So a higher liquidity requirement means that you have a lower time horizon, right? Keep your money in treasury bills or commercial paper, money market funds. Legal and regulatory, again, there might be some insider trading concerns here if your client has a relative working in this company. So then if you're buying the shares of that company, be careful. You don't want to get into any kind of regulatory issues. And unique circumstances, maybe some clients want to have green investments. So ESG factors come into play. Maybe there are some Middle Eastern clients that are Sharia conscious. So then you need to obviously choose your investments accordingly. So that brings us to these very interesting ESG factors. Now there's multiple different approaches of going about this. Negative screening, positive screening, ESG integration, thematic investing, engagement, active ownership, and impact investing. Now, what does negative screening mean? It basically says, okay, all assets are good, just exclude the bad ones, right? So any company which is not good for the environment or society, just take it out. On the other hand, a positive screening would mean that only pick out the good ones. So it's just a difference in approach, that eventually if you exclude the bad ones, then you're assuming the good ones are left, but the moderate ones will also be left. So with a positive screening, you just pick out the good ones and just leave everything else. Or you could just integrate ESG into your analysis. So, for example, if I am looking at the market price versus the intrinsic value, right? That's my core fundamental analysis. And in addition to trying to find a decent upside, I also then add to my analysis procedure a component of ESG, that, okay, I will also check the ESG score. Now, how that score is calculated is a controversial topic because recently, what happened was Tesla got removed from the S&P ESG index, and Elon Musk made, he tweeted about it that what is the basis of the score calculation? How can Tesla, which is doing electric vehicles and clearly should be good for the environment, so why is Tesla going out? And then Exxon, which is an oil and gas company, and Philip Morris, which is a tobacco company, so Philip Morris maybe not so good for the society, Exxon maybe not so good for the environment. Now I'm just giving you an example that the reality is that Exxon was included and Philip Morris was included in the S&P ESG index because the current way of calculation of the score is not just giving points to environment but also to social and governance factors, which includes like gender diversity and inclusion, etc. So there are a lot of other components of ESG. So the jury is still out on how to improve the ESG score, but what you need to know is that in terms of ESG integration, what we do is in our whole fundamental analysis and the stock research process, we include a component for ESG score, and we try and then include those companies in our portfolio which have high ESG scores if the client wants that. Thematic investing. So a client might say, I don't care about everything else. I just care about the environment. So just pick out, green companies for me. So in that case, obviously Exxon and Philip Morris go out the window, right? And then Tesla is probably going to get into the portfolio. You could have a Middle Eastern client saying, I'm only interested in Sharia compliant companies. So all alcohol and banks and tobacco companies, and they will go out. Very interesting concept. This is a subset of shareholder activism, you can say. Now, let me just remind you what was shareholder activism. And activism, that is basically you buy some shares of a company, then you kind of rally the other shareholders around you, and then you ask them to give you their proxy, and then you try and get your people on the board, and then you try and force the management to do something that you want. Now, what you want could be to make the company more environmentally, friendly. Or it could be that you want to shut the company down and just sell it for its parts, right? So shareholder activism is not only used in ESG, it could be used for anything. That the management might be just using the company's resources and just having a party themselves. So the shareholders would say that, okay, enough is enough. We don't want to fund this anymore. It's our money. Let's sell the assets and close this company down and just pay ourselves a huge dividend. Or the shareholders could, grow a conscience and try and force the management to do something about the environment. I think a very good case study for this would be the Indian Tobacco Company, where the shareholders said that why do we only have to sell tobacco? Why can't we get into healthier businesses like food products, etc.? Right? So that is an interesting case study. And what's really coming up these days is impact investing. That, okay, I want to make an investment for my clients, but what is the impact of that investment, right? Not only do we want to make money, but we also want to have a positive impact on the environment, on the society, and we want to have a maximum impact, positive impact on the environment and society. So that is impact investing. That not only do you measure the risk and return, but you also measure the impact that you will have, the positive impact that you will have on the environment and society. And again, the calculation of that impact is still something which is like the ESG score. It's in the works, still. It's a work in progress. Right. So how do you go about doing all of this? Obviously, you need to understand where your client is coming from. What are their circumstances, right? In terms of their dependents, how many people depend on them, what's their job situation like, is it like stable or not, and how much is their expenses, how much are their expenses, what's their income, how much saving have they got, right? So all of this is really, really important. Age, very, very important, is their age. So if obviously you're dealing with individuals, if it's an institution, then again, whose money are they managing? Is it a bank using demand deposit? Is it an insurance company that might need to pay out claims? Or is it an endowment fund which is just, having that investment for the longest period of time, probably never going to need to use it. So yeah, it's really important to get all that information. And then you make the EPS, IPS, and you start constructing the portfolio, right? The first thing you'll do is do your capital market expectation. Now, what does that mean? And this is such a lovely topic, and it's there in detail in level 3. I mean, of course, at level 1, we're not going to talk about it too much, but it's really fantastic because what you have to do is now you understand that, okay, what is the risk and return that my client needs in terms of the R&R objectives. The LLTTU, right? And RRTT, And now you need to figure out, okay, how can I achieve these risk and return objectives? What's happening in the market and what are the expectations for the future? So in level 3, you'll learn how to do that. But then obviously, even now you can understand that what markets are we talking about? So we're talking about the stock market. We're talking about the bonds market, right? What do you think is going to happen in real estate? What do you think is going to happen to the commodity prices, etc., etc.? So you develop a certain expectation about about what will be the return and what will be the risk in all of these going forward, right? And it's not just standard deviation. I mean, we can have multiple different measures of risk. You can have beta coming in fixed income. You already know that there is modified duration, money duration, right? So I mean, we will analyze all of this and say, okay, what is the return we can expect? What's the risk that's going to come with it? And how can we make a mix of these, right? A portfolio, how can we construct a portfolio of these that will, without compromising on the TTLLU constraints, will achieve our R&R objectives, right? And then once you kind of put those two together through a very interesting process, which is called mean variance optimization. Again, more on that, level 2 and level 3, mean variance optimization. Also a very fascinating concept. Then you try and optimize, you use a software to come up with this optimized ideal strategic asset allocation. And then of course you can temporarily deviate from that, and this is something we have discussed before, that if you decided to put 40% in stocks, right, 40% in bonds and 10% in commodities, 10% in real estate, and you just in the middle of the life of this portfolio, you feel like, oh, inflation is going to go up. The Federal Reserve has been printing a lot of money, and usually commodity prices go up and inflation goes up and the market takes a hit, because obviously then the Federal Reserve has to increase the interest rate to, control the inflation. So then the market takes a hit, because from an economics perspective, you're basically going to then go down, because when inflation is picking up, you're probably overheating, right? You're at the peak. So because inflation is a lagging indicator, I mean, this is material you should be remembering from your economics chapters. So that means that what you would do on a tactical basis, just for a temporary deviation from your strategic asset allocation, is you would probably just, tone down the equity exposure and invest in commodities. And while the business cycle turns and your inflation cools off, you take your gains from the commodities and then come back into the stock market. So that's a temporary deviation on a tactical basis from the SAA, but then obviously you have to go back to the SAA, right? So you make your strategic asset allocation, you allow and you write down in the IPS how much deviation will be allowed, and then you start constructing the portfolio. So you select your securities. So this is the mean variance optimization that I was talking about, that you take the RRTTLLU, you take your capital market expectations, right? And then you pump them both in, you just put them in as input into this software, which then spits out the ideal strategic asset allocation. So this is something you will learn more about at level 2 and level 3, right? With time, the asset allocation drift from the target. Obviously, you have to keep rebalancing, right? I mean, maybe stocks have gone up, bonds have come down. So you need to just sell some of the stocks, buy some more bonds. And this is just something that keeps going on. And very important point, by the way, and I've already emphasized on this, I'll emphasize on this again, that the strategic asset allocation and rebalancing policy is in the appendix, right? It's not in the guidelines. Guidelines are just guidelines. They're like an executive summary of these documents. The detailed documents are in the appendix, and you might get a question on that. So just please remember that. Right, now, what are the different asset classes? This is another pet question. So within the asset class, so you've got equity, right? And inside equity, you've got, let's say, American Airline and Exxon. And I've been giving you these examples, right? Telling you, when oil price will go up, Exxon will benefit and American Airline will take a hit. And yes, they might have a low correlation and they might give you a diversification benefit. But when it comes to portfolio management and diversification, that diversification is not within the asset class. It is like across asset classes. So first, you do your strategic asset allocation across different asset classes. And then, within the asset class also you can diversify. But the concept you have to remember is that if you get a question like this, which says where is the correlation going to be lower between asset classes such as bonds and stocks, or between assets within the same asset class, and you have to choose between asset classes, right? Even though you might be tempted to choose that, within the equity market I can find assets with completely opposite movements, so very, very low negative correlation. But the correct answer here is that the correlation will always be lower between asset classes, right? That is the high level strategic asset allocation. And you can see that over here, right? Equities with fixed income is very, very low, right? So given the matrix on the left, which asset class is more sharply distinguished? What does sharply distinguished means? That has the lowest in terms of negative correlation, right? As low from positive +1 as possible. So 0 or -1 in this direction, that would be sharply distinguished from equity. So I mean, if you look at the entire comparison of equities with itself is obviously going to be 1, right? But then you've got fixed income almost -4. So that's pretty good, right? Everything else is positive. So this is negative. So the answer is definitely fixed income, right? So what have we done so far? You make the SAA, you define the TAA, and then you start doing your security selection, right? Very, very interesting concept, by the way, and risk budgeting. And this is something which is up and coming. So see what's basically going on in the world is that, and let me just talk about this with this matrix. Now, you see that hedge funds have a pretty high correlation with equities. Real estate, private equity, very high correlation as well. So what that really means is that, I mean, when the crisis hits, they all crash. I mean, think of 2008, think of 2008 global financial crisis, think of the COVID 2020, March 2020 crash. I mean, what's the point of diversifying if they're all going to crash together? So now what we are seeing more than strategic asset allocation, what is a upcoming concept is something called risk budgeting. Now, what risk budgeting means is that the client will say, hey, here's $100 million, right? I mean, I'm just going to tell you from an R&R perspective that I want a 15% return, right? And in terms of the risk, you can take, let's say, a beta of 1 or let's say half. So you can't take more than half this money into the market exposure, right? So beta should not be more than half. Let's say if you're putting it in bonds, so the modified duration should not be more than, let's say, 4%, right? So for every increase in 1% increase in interest rate, the portfolio value should not fall more than 4%. So what they would then do is that they would talk to you in terms of risk, and they would define a budget that, okay, this is the budget you have. So the entire portfolio should not have a beta of more than half and a modified duration of more than 4%. And then now you go about and do your strategic asset allocation. They don't care what asset classes you're going into, right? They've just put a risk budget on it. And this is actually a very, very smart way of going about doing this. The reason for that is what we have seen, and as you will learn as you do your level 2 and level 3, is that in terms of the arbitrage pricing theory, which is one of the multi-factor models which you studied after studying CAPM, which is a single factor model, of course, capital asset pricing model. And this is all material that we've discussed in the portfolio management 2 readings of risk and return, part 1 and part 2, is that what you will see is the return that is coming in is actually coming in based on how much risk you're taking, how much good risk you're taking. So if it's the risk that you're actually controlling, I mean, you can't control the return. You can control the risk. You can decide how much risk you want to take, what type of risk you want to take. So you choose the type of risk you want to take, you make a budget for it, right? And then the return just comes on its own. So this is a very interesting new concept and new way of going about doing your portfolio construction, up and coming. Of course, passive versus active investing, we've talked about this many times, and the reason why passive is taking off so much is because markets are becoming more and more efficient, and both informationally and operationally, right? So it just makes sense to just buy and hold. And that's low cost as well. I mean, why pay such high fees for active investing when the performance is really not that much? So what's really going on? This risk parity investing approach is what I just talked about in terms of the risk budgeting. Same thing. And your increasing use of ETF in combination with robo-advice. This is the same discussion we had with respect to the mass affluent segment, that what's really happening is, and I can tell you firsthand that this is so true. It's such a practical statement that earlier what would happen is that we would not be interested in serving clients who were not having that much money, because obviously physically we have a limited capacity of being able to serve clients. But now with algorithms and artificial intelligence, what happens is that we can automate a lot of the trading, which means then we can serve clients which we weren't able to serve before, because we can just automate their trading in their portfolio. And how we could use ETFs to do it. Now, the difference between an ETF and a mutual fund, because mutual fund, an open-ended, can't be traded during the day. A closed-ended can be, but then new investment is not possible. But with ETF, you can increase investment, you can reduce investment, you can trade during the day. It's low cost, it has tax benefits, you can completely automate that, and it's just so wonderful. So what's really happening is that this combination of ETFs with algorithmic trading is really taking off in terms of portfolio management. And you've got the most wonderful ETFs available these days. I mean, if you want to take an S&P 500 exposure, right, just you could buy SPY. And that's just a passive investment one. If you want to take active investment ones, there are so many ETFs available, like one for artificial intelligence companies, one for electric vehicles, one for everything under the sun almost you can find. Very nicely put together ETFs. So this is definitely a space to watch. Right. So ESG, there is a debate that is this good for the portfolio or bad. So some people are saying that it's good. I tend to agree with them as well. Some say it's bad. Now, let's say, for example, if you're investing in Exxon and Exxon is making a lot of money, but if you don't want to invest in Exxon because it's not good for the environment, apparently. I mean, I'm not making any statements here, just to give you an example, that let's say Tesla is better for the environment. Now, some people might say, no, but Exxon is a very profitable company, so we want to invest in Exxon. And if you don't invest in Exxon, you'll lose out in terms of your return on your portfolio. So that's one perspective. The other perspective is that, hey, your return will get enhanced if you take that ESG consideration into account. Now, what's the logic in their argument? I'll explain it to you. See, what they're saying is that eventually there will be improvements in governance, such as, let's say, the global Paris Accords, which are not being followed to the letter properly. But just assume that one day all the leaders woke up and they said, okay, we're now going to implement some big measures, like all fossil fuel cars sales stop. Nobody can sell a car which is going to use fossil fuels anymore, right? So, I mean, what do you think is going to happen to the Tesla share price that day? It's going to rocket. So, yeah, I mean, there's definitely a very strong argument that it's only a matter of time that ESG factors will start enhancing returns. If you are careful and in your choices of investments, you're taking ESG into account, it's definitely going to pay off. That's the argument by the proponents. Okay, so what's the summary here? We talked about how do you go about understanding your client's objectives in terms of risk and return, right? And then that's obviously going to be based on their circumstances. So you have to really understand their position in life in terms of their job, their family. If it's an institution, then of course, what is it? Whose money are they managing, etc. And then you start putting together your IPS once you understand the client's story, right? What is the purpose, scope, duties and responsibilities of all parties involved? That includes you, the client, and any other parties involved, especially there will be custodians, right? Etc. Methodologies for updation of IPS, risk and return obviously are going to be in the objectives, TTLLU in your constraints. Then the guidelines is an executive summary of strategic asset allocation, leverage, rebalancing, etc. But the detailed policies will be in your appendix. And of course, with respect to the evaluation, it can be relative or absolute, and you need to exactly state how the portfolio evaluation will be done, the performance evaluation will be done, because we're not going to want to fight with the client later that we've done such a good job and the client's not appreciating it. It has to be a clearly written out, pre-agreed way of how we're going to, compare the investment results. All right, so then we talked about absolute and relative risk and return objectives, right? They can be both absolute and relative. I gave you examples as well for that. And then we had a detailed discussion about ability and willingness. And I linked it with the next learning module, which you're going to see that you've got your behavioral biases, and this is an emotional bias, right? It's a psychographics oriented bias, and you don't want to force somebody to take a higher risk when, even though they might have the ability to do it, but they don't have the willingness. Whereas somebody who doesn't have the ability, right, but has the willingness, you need to stop them from taking that risk. I mean, you have to do your best to stop them. Right. TTLLU. I don't think I need to explain this any further. You're probably an expert of this by now. And also, just in terms of the asset classes, you have to go into the sub level as well. So it's not just that, okay, I'm going to put 40% money in bonds. How much are you going to put in corporate bonds? And how much of that are you going to put it in junk, right? Which is your non-investment grade, or it's also called speculative, or also called high yield. So how much is the budget for that? Right. Of course, the correlations within the asset class are usually high. Even if it's American Airline and Exxon, they both crashed when your financial crisis was there or when your COVID lockdowns were announced. So when the market goes down, everything goes down. So when you're talking about strategic asset allocation, it is across asset classes, right? Across asset classes. And that's your SAA. Temporary deviation from that is going to be your TAA. And then the security selection process obviously involves putting together the portfolio within those separate asset classes. Negative screening is taking out the bad ones. Positive screening is picking out the good ones. ESG integration is taking your ESG scores and making it a part of your analysis process. Thematic could be based on some theme like green or Sharia, right? Engagement, well, this is something which I told you. Shareholder activism is not just for ESG, it could be for ESG, but other things as well. It's just that the owners get active, right? Impact investing, that you not just try to get a risk and return target, but you also have a target of making a positive impact on the environment and the society, right? And we continue to see good, strong adoption of this, which is very, very good. And we believe, when I say we, the proponents of this approach, is that this enhances return as well.